All right, so today we're diving into Netflix's Q4 2024 earnings.
Yeah.
We've got their shareholder letter,
Yeah.
and we pull out some interesting stuff from the earnings call. We're really going to go beyond just what the headlines are saying.
Absolutely.
We'll give you all the financial details, of course, but we're also going to dig into like their strategies behind it all, like how they're handling this whole world of live sports now, what's going on with their ad-supported plans, even getting into video games a little bit. Are you ready to kind of see like what's really fueling all this success they're having?
Yeah. What I think is so fascinating is how Netflix has managed to just bounce back. In such a crowded entertainment world. I mean, they added a record 41 million subscribers in 2024. That brings their total to 302 million worldwide. That's a 16% jump in revenue. And, that's not easy to pull off these days.
No, it's not. And Q4 alone was just like a home run for them. They just crush their own projections. They added 19 million new subscribers. That's the largest single quarter growth they've ever had in their history. That's more than some like entire streaming services have.
Right. It's amazing. And it really shows they're not just keeping up, they're like surging ahead. Their operating income also just skyrocketed 52% to $2.3 billion with a 22% operating margin. I mean, that means for every dollar they're bringing in, almost a quarter of it is pure profit.
Wow.
It gives them so much room to invest in new content technology, whatever exciting ventures they're thinking of next.
Yeah. What's the secret sauce here? They're talking about Squid Game Season 2, the film Carry On, live events like the Jake Paul versus Mike Tyson fight.
Oh, yeah.
And they even snagged 2 NFL games on Christmas Day. So it's like a pretty wild mix.
It's super diverse, and they're really emphasizing that this diversity, this offering something for everyone is really working for them. They're not just relying on those like blockbuster hits, They're finding success across a bunch of different international markets. They're leaning into comedy. They're experimenting with all these different genres and formats. It seems like they really want to be that go-to for every mood and every taste.
Yeah, but it doesn't seem like they're just throwing spaghetti at the wall and seeing what sticks either. Like they're being very strategic with stuff like live programming. It's still a pretty small part of their overall viewership. But they're focusing on specific events like the Women's World Cup. Instead of just, going all in on full season rights for the big leagues.
Right. That's a good point. They're kind of testing the waters, seeing what resonates with viewers and what makes financial sense too, because, those full season rights can be so expensive, they're not jumping in blindly at all. Instead, they're picking their battles, and it looks like it's paying off. Like, their WWE programming is already pulling in way bigger numbers than it did on regular TV.
That's awesome. So speaking of strategic moves, let's talk about that ad-supported plan. It's been like a hot topic in the news, and the numbers are actually pretty impressive.
They are.
It already accounts for over 55% of signups in countries where it's available.
It's clear that ad-supported tier is hitting a sweet spot, especially for folks who are budget conscious. Membership in the ad plan grew by almost 30% just this past quarter. So this isn't just some trend. It's like a fundamental shift in how people are getting their streaming.
Yeah, I mean, it makes you wonder, like, with all this success across all these different areas, are they on track to becoming like that one-stop shop for everything we could possibly want to watch? It's kind of mind-boggling.
Right. It really is. And they're not slowing down either. They're investing a ton of money in their own ad tech platform. So they're giving advertisers more tools and making a better experience for viewers with more relevant ads. It's all about refining the model and making it work for everyone involved.
I like that. So it hasn't been all like smooth sailing, though. They have a lot of their revenue coming from outside the U.S., so they're dealing with currency fluctuations, right? Especially with the dollar being so strong.
Yeah, that's a tough one. And it's a challenge that any global company faces, Strong dollar means that their earnings in other currencies are worth less when they convert them back.
Oh, I see.
But they're not just sitting around. They're actively hedging about half of their non-US dollar revenue to kind of smooth out those ups and downs.
So they're taking out like an insurance policy against the wild currency swings.
Yeah, exactly.
Making sure those fluctuations don't like mess up their investments and their planning.
Yeah, exactly. And for the long term, they're looking at this mix of natural hedges, like adjusting prices in different regions and managing their costs more tightly. It's all about being proactive and having a plan.
I like that. All right, let's switch gears to something a little more fun. Video games. Netflix is still relatively new to this whole thing, but they're making moves, especially with games, that are based on their own popular shows and movies.
Right, it makes total sense. They've got this treasure trove of recognizable characters and stories, and they're hoping to hook their existing fans and maybe even introduce some people to gaming who might not have tried it otherwise.
Yeah, and they're not just focused on one type of game either. They're experimenting with everything from like story-driven adventures to party games, kids games, licensed titles, like
It's smart.
it's all over the place.
It lets them explore all those genres, see what their audience actually likes, and gather all this valuable data. It's early days, but it's definitely something to keep our eye on.
For sure. Speaking of things to watch, let's talk about their pricing strategy. They're sticking to this whole thing of only raising prices when they feel like they're giving more value to their members, and they're pointing to engagement retention and all those new subscribers as proof.
It's a really classic value-based approach. They're not just randomly increasing prices, you know. They're tying those increases to actual improvements, and it seems to be working. Those recent price hikes in certain regions haven't scared people off, which means they're confident they're giving a service people are willing to pay for.
Yeah, and they're also talking about that low starting price for the ad-supported plan as like a key thing to making Netflix accessible. It's like they're trying to cover all the bases, different budgets, different preferences.
Right, they're recognizing that not everyone can or even wants to pay a lot for a subscription. By having different price tiers, they appeal to a wider audience, and they stay competitive in this crazy market.
So with all of this in mind, what's their outlook for 2025? Are they going to keep growing, or have they hit like a ceiling?
Well, they're projecting about $18 billion in cash content spending for 2025, which is a bit more than 2024, so that tells me they're still hungry for more. They're still willing to invest a lot to keep their viewers engaged.
That's a lot of dough.
It is, but they seem pretty confident they'll make it back. They're forecasting 2025 revenue of like $43.5 to $44.5 billion. That's like 12 to 14% year-over-year growth. They're not messing around. They expect a serious return on that investment.
Yeah, and their target operating margin for 2025 is 29%. That's up from 27% in 2024.
Right, which means they're expecting to become even more profitable as they grow. They're also committed to a $17.1 billion stock buyback program, which shows confidence in the future.
So we've covered a ton of ground, but before we dive into that earnings call, what are some of the key takeaways that stand out to you?
What really strikes me is how well they're balancing growth with profitability. They're not just chasing after subscribers no matter the cost. They're making these strategic choices to expand their reach while boosting their financial performance. They're investing in new stuff like live programming and gaming, but they're doing it carefully and with discipline. And they're handling those external challenges like those crazy currency swings. It's impressive.
I agree. It's like they're walking a tightrope and managing to keep everything going without falling off.
It really is impressive. All right, so let's see what we can learn from this earnings call. It looks like they had a lot to say about their content strategy, especially given how successful those live events were.
All right, let's get into it.
So the earnings call kicks off with Spencer Wang. He's their VP of Finance, Investor Relations, and Corporate Development. He welcomes everyone and kind of sets the stage for what sounds like a pretty exciting call. He's joined by co-CEOs Ted Sarandos and Greg Peters, and CFO Spence Neumann, a real power lineup.
Yeah, so first up is Dan Salmon from New Street Research. And given the recent wildfires in Southern California, he asks about potential production disruptions and how that might impact their cash content spending for the year.
Yeah, that's a big concern. So Ted Sarandos jumps right in. He acknowledges, it's a tough time for everyone affected by those fires. And he talks about how the company is doing what they can to support those folks. Thankfully, he says there haven't been any major delays in projects and no impact on their 2025 cash content spending. So
it's good to hear.
Yeah, it sounds like they're really putting the safety and well-being of their people first, while still keeping things on track.
Absolutely. All right, so next up is Jason Helfstein from Oppenheimer. And he's got a question about that huge subscriber growth. He's wondering if those big events like the Jake Paul fight and the Christmas Day NFL games were the main drivers.
Right, like were those the big draws?
Yeah, because it seemed like those events got a ton of buzz.
They did. But Greg Peters makes it clear that while those events were definitely successful, they only make up a small piece of the new subscribers. He says the real driver was the strength across all their content and all their regions, combined with their marketing efforts.
Got it. So it was like a team effort, a win for their content strategy as a whole, and not just a few big things.
Exactly. Yeah, and Ted Sarandos adds that their whole business is built on providing variety and quality that appeals to all sorts of tastes all over the world. And he points to how well other content did, like Squid Game Season 2 Carry On, and some international titles too, proving it's not just about those flashy events.
That makes sense. They're trying to create a global platform with something for everyone.
Oh.
Oh, and it's interesting that they also said subscribers who joined for those live events are sticking around at like a similar rate to those who joined for other content.
Oh, that's a really good point. It means they're not just attracting people for a one-time thing, they're converting them into long-term subscribers who are watching all sorts of stuff.
Exactly.
Okay.
All right, so Stephen Cahall from Wells Fargo brings up that challenge we talked about, the strong U.S. dollar and how it's affecting their financials.
Right, so Spence Newman, the CFO, explains that they're hedging about 50% of their non-U.S. dollar revenue on a rolling 12-month basis. You think of it like insurance against those currency swings.
Oh, okay, so they're being proactive about managing that risk, but it sounds like hedging is just a short-term solution.
That's right. Spence says that their long-term focus is on managing the business itself, using natural hedges like adjusting prices in different regions, and fine-tuning their cost structure. It's a multi-pronged approach.
I like it. They're not just relying on financial tools. They're looking at the big picture. Okay, so Brian Pitts from BMO Capital steers the conversation towards advertising, and he asks about what they've learned and the challenges of making money from this fast-growing part of their business.
So Greg Peters is super enthusiastic about that ad-supported plan. He talks about how popular it is, how fast it's growing, and the good engagement they're seeing.
That's great. So it sounds like they're really happy with how it's performing. But are there any hurdles they're facing?
Well, Greg admits that improving their advertising offerings is a top priority for 2025 and beyond. But he doesn't see any major roadblocks. He even says they already beat their ad revenue target in Q4, and they expect to double their ad revenue in 2025.
Wow, that's impressive. It sounds like their advertising business is becoming a big deal for their revenue.
Absolutely it is. And Jessica Rafe-Ehrlich from Bank of America, she follows up on the advertising discussion and asks if they have the tech and tools to really scale up.
Yeah, that's a good question. They're clearly doing well, but can they keep it up as they get bigger?
So Greg Peters says they're moving from the crawl to walk phase in 2025, thanks in part to their own ad tech platform. They launched it in Canada and are seeing good results. And they plan to bring it to other markets, including the US, in April.
So they're taking control of their own advertising destiny.
Exactly. They believe this platform will boost sales, create a better experience for members with the ad-supported plan, and just make the whole advertising ecosystem stronger.
It sounds like everyone wins. Advertisers get better tools, viewers get better ads, and Netflix gets more money. Okay, let's talk sports. Ben Swinburne from Morgan Stanley asks about their interest in full-season sports rights, especially after those NFL games did so well.
Right, everyone was watching those. So Ted Sarandos acknowledges the success of those NFL games, but he says they're not changing their mind about full-season rights. They're still focused on special events instead of committing to whole seasons.
Okay, so they're sticking to their strategy of being picky.
Yeah, he says they're always looking for ways to expand their programming. But the economics of big league sports are still tough to justify.
Yeah, those sports rights can be super expensive.
They can.
So Rich Greenfield from Lightshed Partners follows up, asking if the success of the Jake Paul fight and WWE Raw has changed their thinking about getting rights to events like the UFC.
Good question. So Ted Sarandos doesn't comment on the UFC specifically, but he does highlight how well their WWE programming is doing. It's already got bigger numbers than it did on regular TV.
Wow, so they're seeing the potential of live sports, but they're still being cautious and strategic.
Yeah, exactly. He emphasizes that the numbers have to work for both Netflix and the sports leagues. So Vikram from Baird asks about their decision to get the rights to the FIFA Women's World Cup in 2027 and 2031.
Oh, wow, that's a big one. That's a global event. It'll be interesting to see what they do with that.
Definitely. So Ted Sarandos explains that getting those rights fits perfectly with their strategy. They want to focus on these special events that have a wide reach and are culturally relevant. He mentions the growing popularity of women's sports and how the event could draw a massive audience. They're clearly excited to showcase these games and tell the stories of the athletes.
That's awesome. It seems like a perfect fit for their platform.
All
right, let's get back to movies. Rich Greenfield from Lightshed Partners brings up the success of Carry On and asks if it proves that movies can break through without being in theaters first.
Interesting question. So Ted Sarandos uses this as an example of a Netflix movie generating huge buzz. It did better than expected and even got people talking. He says it's because of the power of the Netflix platform. to promote movies directly to their members and use social media.
So they're skipping Hollywood and doing things their own way.
Exactly. And then Doug Anmuth from J.P. Morgan follows up. He asks about their agreement to release Narnia in IMAX theaters in 2026. He wonders if this means they're changing their strategy about theaters.
Yeah, it's interesting. It seems a little different than what they usually do.
It does, but Ted Sarandos says there's no change in their strategy. They're still focused on giving their members exclusive movies first. The IMAX release is more of a tactic to create buzz, maybe get some awards, and offer a special viewing experience for some movies.
So they're being smart about it, using theaters selectively to boost certain films. Okay, back to Vikram from Baird. He has a question about their price increases, especially in their biggest markets.
Right. So Greg Peters explains that their philosophy hasn't changed. They only want to raise prices when they're giving more value to members. And he points to engagement, retention, and all those new subscribers as proof.
So they're not just doing it to make more money, they're trying to make the service better too.
Exactly. He mentions those recent price increases that went well in some areas and how their low starting price for the ad-supported plan helps keep things affordable.
Yeah, they're trying to appeal to everyone. All right, now Peter Supino of Wolf Research asks about engagement and how important it is for Netflix.
So Ted Sarandos is very clear that engagement is a top priority. He says their goal is to entertain the world and get people watching more. He knows it's tough to compete for attention these days, but he's confident they can deliver content that keeps people coming back.
So it's all about creating must-watch stuff that keeps people glued to their screens.
Yeah, absolutely. And Spence Newman adds that engagement drives their whole business. It leads to more revenue and profits. It's the key to their success. They also say they'll release an engagement report twice a year starting in February to be more transparent and give people more insight.
Oh, that's a good idea. It shows they want to communicate openly with investors. So Justin Patterson of KeyBank asks about how they're going to compete. With those short-form video platforms for engagement, like those are really popular, especially with younger viewers.
Yeah, they are. So Ted Sarandos acknowledges that short-form content is popular, especially with younger folks. But he emphasizes that Netflix's strength is in professional, longer-form storytelling.
So they're sticking to what they're good at.
Yeah, he believes there's still a huge demand for great movies and shows, and that Netflix is in a good position to capture that audience with their content. He also sees the value of those short-form platforms for finding new talent and ideas, and points out that Netflix has adapted successful projects from other platforms before.
All right, so they're not ignoring those platforms. They see their value. Okay, so Alan Gould of Loop Capital wants to talk about video games. He asks about their progress and how it's affecting subscriber growth and retention.
Right, so Greg Peters admits they're still new to gaming, but they're making progress. He talks about some of their successful games, including those based on their shows, and says he's excited about the future of this new area.
Yeah, it's clear they want to grow beyond just streaming. But is it actually working?
Well, they're already seeing some positive effects on both getting new subscribers and keeping them, although it's still small.
That's good to hear. It sounds like games are adding value for some subscribers.
They are, and for the future, they plan to keep refining their game strategy, focusing on games based on their own stories, party games, games for kids, and more well-known titles.
So they're trying different things to appeal to lots of different gamers. Yeah. Okay, Jason Helfstein of Oppenheimer is back. He asks about their long-term content spending plans. Given that they're projected to spend $18 billion in 2025, that's a ton of money.
It is. So Spence Newman addresses this. He says there's still a long way from being done with content spending. They have a relatively small share of viewers and haven't fully reached all global markets.
So they see a lot of room to grow and think investing in content is the way to do it.
Exactly. And he says they're being careful with their spending, putting money into areas that will have the biggest impact, and keeping a good balance between their content costs and their cash flow.
That's good to know they're not just spending recklessly. Okay, last question from John Blackledge of TD Cowen. He asks about the reasons behind their higher operating margin guidance for 2025.
Okay, so Spence Newman explains that it's all about balancing revenue growth with smart investments. He says they expect high single-digit expense growth in 2025, which is less than their projected revenue growth.
So they're going to make more money than they spend.
Exactly, and it's a good sign for investors. He then breaks down their expected expense growth, saying that content costs will likely grow in the high single digits, and they'll also be investing in product development, marketing, sales, and other areas.
So they're investing in everything, but in a way that supports their growth and improves their profits.
That's the goal. And with that, Spencer Wang wraps up the call And thanks, everyone, for joining.
Oh, that was a lot of information.
It was. We got a much better understanding of their content strategy, their approach to live programming and gaming, their progress in their pricing, their thoughts on engagement, and their overall outlook.
So now that we've gone through all of that, what does it all mean for Netflix? What are the key takeaways for you?
I think it's clear Netflix is doing really well right now. Their content is working, the ads are taking off, and they're being smart about how they're getting into live programming and gaming. They seem to get their audience and aren't afraid to change things up.
Well, that brings us to the end of our deep dive into Netflix's Q4 2024 earnings. We hope you found it helpful and maybe even got you thinking about some things.
Yeah, definitely. And remember, we always love hearing from you. So if you have any thoughts or ideas about Netflix's future, leave us a comment or send us a message. We're always up for a good discussion about the companies and industries that are shaping our world.
Until next time, stay curious, stay informed, and keep on diving deep.